How to invest in stocks, stock market tutorial. David Jaffe with beststockstrategy.com, and in this video you're going to learn the best way to earn consistent profits in the stock market as a trader. So the reality is that the best way to earn consistent profits in the stock market is to actually not own stocks, and you definitely don't want to trade stocks because there is no statistical advantage to owning stocks. We all know that when you're long stocks, they tend to go up around 52% of the time. Yes, you can definitely make money by being long a company like Amazon, or prior to about 4 months ago, a company like Facebook, but you do not have a statistical edge. In fact, owning stocks is extremely passive, and we have been in a bull market for around 10 years, and 2018 so far has been extremely volatile. You had an incredible month in January, followed by the correction in February, and October 2018 was the worst month in around 7 years. So even though I cannot tell the future, I believe that the market is going to be relatively stagnant for the remainder of 2018 and also in 2019. Perhaps we might even enter in a recession. If you want to make money in the stock market, the best way to become a profitable investor in the stock market and in stocks is to sell option premium. So I'm going to run you through the best way that I know in order to invest in stocks and to make money in the stock market. So it's as follows, and it actually is extremely scalable. It doesn't matter if you have $2,000 or $20 million. The only thing that you're going to vary is the number of contracts, and perhaps when you have a larger account of $100,000 or more, instead of trading verticals or spreads, you will start to trade more naked options. If you don't understand what I just said, don't worry about it. It's completely okay. I'm going to explain things right now. So the first step that you want to do is to have a watch list. Considering that I believe that the remainder of 2018 and 2019 is going to be extremely volatile because the VIX right now is trading for around $20, which is around twice as much as it was trading for during 2017, you want to make sure that you have only A+ opportunities and the best stocks on your watch list. This is the watch list that I recommend. You would have Lockheed Martin, Raytheon, Boeing, McDonald's, which is recession proof, Dollar General, which is recession proof, JP Morgan, and Facebook. So Facebook is not really a market leader. I mean, it's down 33% so far in 2018. But the reason why I'm including Facebook is that it's been beaten down so much that that I can't really see it trading much below $120. Right now, Facebook is trading at around $140 a share. So if it falls an incremental 15%, you can still easily make money on that by selling puts with a strike price of around 120. So with these positions, you have a lot of diversity because you have multiple industries that are being represented. This is defense, this is food, this is recession proof. This is a dollar store, it does sell goods for more than $1. This is a market-leading finance industry bank, and then this is also in like a FANG stock and an internet stock. So you have 5 industries here. I don't care if you have $20 million. This is enough diversification for you because all of these are A+ opportunities. So what you do is right now, Lockheed, I think it's around 305. Raytheon is around 181. Boeing is around 350. McDonald's is around 184. Dollar General is around 115. Today is October 13th. So you can, if you want, you can look up these prices. JP Morgan, I think, is around 108. And Facebook, I think, is around 143. All right? So the problem with investors is that when they try and buy and sell stocks, what they do is they're going to wait and they're going to think, hey, Lockheed Martin earlier this year was trading around $390. This is a great opportunity to buy it. Let's buy it at $305. The issue is you're not sure if Lockheed is going to go up or go down. Like 2 weeks ago, it was trading at $290. So if it falls when you buy it at $305, you're going to show a large paper loss. You're much better off instead of buying the stocks outright, instead you would use the derivative markets and turn yourself into a casino and become an insurance company and collect premium. That's how successful investors make money in the stock market. They invest by selling option premium. So in this situation, what you do is you would be patient and then you would simply wait. So LMT is trading at 305. What you do is you wait for LMT to trade at 295. You wait for RTN to trade around 175, Boeing to trade around, around 340. McDonald's, since it's trading right now near its high, you'd wait for it to trade around 175. DG's also close to its high. I think its high was around 118. You'd wait for it to fall to around 110. JP Morgan, maybe you'd wait till it fell to around 102. And Facebook is trading relatively close to its low, so you would wait for it to fall to around 138. Now, these will be your triggers. So you would have all of these stocks. It's not really that many. It's only 7 securities. And then you would get comfortable with their trading range, which you can do by simply logging onto your account once a day. And then you would just simply wait. You would wait to see if Lockheed fell to 295, Raytheon fell to 175, etc. But unlike stock buyers and investors, what you would do is you would wait for it to fall down and to drop to these prices, any of these securities. Then you would sell a put for around 10 or 15% below the depressed market price. So remember, at this moment, Lockheed's at 305. At this moment, Raytheon's at 181. But what you're doing, you're waiting for any of these stocks to fall to the range. So around 295, 175, 340, etc. Then you are going to sell a put. LMT, you would sell a put with a strike price of around 280. Raytheon with a strike price of 165. Boeing, you'd probably sell around a 320, maybe a 315 put. McDonald's, you'd sell, I'd say around a 166. DG, you'd sell a 100. JP Morgan, you'd sell around a 92 put. And Facebook, you would sell a put for 120. Now, this is amazing. And you would get paid for all of these positions. So again, just to be clear, right now, Lockheed is trading for 305. You are agreeing to buy Lockheed at 280. Raytheon is trading at 181. You are agreeing to buy Raytheon at 165. Boeing is at 350. You're agreeing to buy Boeing at 320. McDonald's, 184. You're agreeing to buy McDonald's at 166. And in exchange, you are receiving premium. Okay? Now, just like an insurance company, you will choose an expiration date. Usually I like to choose 4 to 6 weeks in advance. However, because the market is so volatile right now, I am generally reducing the expiration that I choose to around 3 weeks. And actually, you're getting paid more money because the VIX, which is a measure of volatility, is very high right now. So near-dated option premium is actually more expensive than expirations in the farther out in time. That's an inverse relationship. I think that means that the volatility curve is an convex, meaning that the near-term volatility is actually higher than the long-term volatility, and as a result, when you sell options that expire in 3 weeks, you're actually getting more premium than you would if you sold some, or at least you get the same amount of premium as you would for selling something further dated out, meaning that you're not being compensated for selling options 5 or 6 weeks relative to how you would have if the VIX is trading at around 11. But anyway, the only takeaway that you need to know for what I just said was that when volatility is very high like it is right now, I do choose to select shorter dated options because you get compensated for more than you would if you chose 5 or 6 weeks out. So you choose 3 weeks, all right? So let's say for Lockheed, which remember is trading at 305 right now, you would sell and agree to buy Lockheed at 280. You would choose, let's say, like the first week of December. That would be the expiration, and you would probably receive around $2.20. So for every contract you sell, you would receive $220 for making that trade. Now, in the event that Lockheed Martin does not fall below $280 before the first week of December, which is your chosen expiration, you would collect and you would keep that entire $220. All right, so again, Lockheed is trading at 320. You would wait for it to fall down to 295. Then you would sell a put at 280, which would obligate you to buy 100 shares of Lockheed Martin at a strike price of 280. Now, what you would do is you would collect then $2.20 of option premium. And if Lockheed Martin does not trade below $280 before the option expires, you would collect and keep the entire $2.20. Now, another thing that I like to do when we're in extremely volatile times is I do like to close out my trades early. So using that Lockheed example, if you collected $2.20, I usually, the second that trade fills, I would then put a closing order in to buy back that option at a price of around $1.20, or $1.10. So I would like to keep 50% of the original premium received. So again, just to recap, Lockheed Martin is trading at 305. I would wait for Lockheed to trade down to 295. Then I would sell a 280 put with an expiration of the first week in December. I would receive around $2.20, which would be the market price of that option. Now you would put in a limit order that would execute at around $2.20. For every option that you sell, you would then collect $220 of premium. Then once that order fills, you would immediately put in a closing order with a price to buy that option back. Because remember, your initial order, you're selling to open. You're selling to open, you're selling something, you're receiving $2.20 per contract. One contract is 100 shares. So you're selling something, you're receiving $220. Once that fills, you are then going to immediately put in a buy to close limit order with a price of $1.10, which is 50% of the premium received, and that trade will be profitable around 85% of the time, maybe even 90% of the time. You can do that with all of these examples. Raytheon at 181, it falls down to 175. You sell a 165 put with an expiration still first week of December, considering that right now is October 13th, 2018. You'd probably collect for that around $1.60. That would mean $160 for every contract that you sell. Immediately once that order fills, you would then put in a buy to close order of 80 cents, which is 50% of the premium received. The other thing is make sure that you watch your size. At all times, you want to have at a minimum 30 to 35%, probably 35% of your account size. So if you have $100,000, you want to make sure that you have at least 35% of your account available to buy, especially with the volatile market that we're in. You actually want to target 45%. So if you have a $100,000 account, at all times you want to target having at least $45,000 available for you to trade. You want to have 45%. That should be your target buying power. Now, that buying power is going to vary every single day and every minute, every second that the market is open based upon the underlying value of your position. So that's why if the S&P falls 3% tomorrow, let's say today you have $45,000. Let's say you have a $100,000 account and today you have 45% of your account available as buying power. If the S&P 500 falls 3% tomorrow, instead of having 45%, you're gonna have maybe 30%. That's why you want to make sure that you have the necessary buying power, because you don't want that buying power to become negative. That way it's going to force you to close out positions at a loss at an inopportune time and therefore suffer a loss. So remember, you want to bend but not break, and especially in this marketplace, this is the best strategy. The other thing that you can do, which I've been doing a lot more recently, is selling call options. So let's say Lockheed Martin trading at 305, it trades down to 305, rather at 295. You would then sell a call with a strike price of 280. Then let's say 3 days later, Lockheed trades up from 295, because remember, it's going to trade at 295, then you would sell the 280 put. Remember, now let's say Lockheed, 2 or 3 days later, it trades all the way up to 310. In that situation, what I would do is I would sell the 330 call option, and I'd probably receive around $1.20 in premium. So I receive $120 for every contract that I sold. The expiration would be the same as the put that I sold. So therefore, you would turn that position into a strangle. I don't like selling strangles from the onset because from my experience, the call side tends to get tested. And also remember, if you're selling a put then inherently that's an inopportune time to then sell a call option. Like for example, if you're selling a put when Lockheed, which is trading right now at 305, if it falls down to 295 and you sell the 280 put, that's a great opportunity for you to sell the 280 put because Lockheed Martin is trading at the low end of its range. But if you sell the 310 call option when Lockheed is trading at 295, not only are you not going to get that much money, but at the same time, you're also taking substantially more risk because right now at 295, Lockheed is trading at the low end of its range, meaning that there's a high probability that over the next few days, it's going to bounce back higher. So if this bounces back to 305, that call option that you sold for 310 is going to show you a large paper loss. And remember, when Lockheed was trading at 295, you didn't even collect that much premium for selling that 310. So I definitely would not do that. I'm very, very selective in selling call options. Again, this is David Jaffe. If you have any questions, you can go to beststockstrategy.com and enter in your email and receive $400 worth of free training. If you want to sign up and receive the in-depth training that includes everything from rolling, that training that I have, the education program, is the best available. You can learn everything that I know about how to be a successful and profitable trader. Additionally, make sure that you do close out your positions early. This is extremely important, especially in this volatile market. So you would review all of your positions. Let's say you sold the Lockheed Martin 290, when Lockheed was at 295, you sold the 280 put. If Lockheed Martin then 3 or 4 days later increased in price to around 305, you should ask yourself for every position that you have, would I make this same trade right now? So if Lockheed was trading at 295 and you sold the 280 put, and then 3 days later it jumps back up to 305, that call, or rather that put option that you sold for $2.20 is probably trading at around $1.10. So again, we automatically want to enter buy to close orders for every trade that we make. But if you don't, what you do is you scan all of your positions and then ask yourself, would I make the same trade right now? And if the answer is no, you close out or you manage the position. This is David Jaffe from beststockstrategy.com. Please like, comment, share, and subscribe to this channel. If you have any questions, leave a comment below, and I appreciate your attention, and I'm here to help you.